Welcome to the Tricord Advisors podcast. This is a show where we talk about life's hard financial questions and help you build the life you love. This is Randy Barkley and Jeremiah Lee. We're both certified financial planners. I'm also a California licensed attorney.
Welcome back. We're going to continue our discussion on charitable giving and ways and methods that you can get a better benefit for that. And we've talked about donor advice funds, but we're going to kind of cross over into some other instruments, aren't we? Some other ways to do this.
Yeah, so the next one to talk about is a qualified charitable distribution.
Okay, so, now what does that mean?
Unpack that, right? So if someone's taking distributions from a retirement account, so a 401k,
an IRA. For those of you that are aware, that's a required minimum distribution. And you're acutely aware if you are 70 and a half or over that age. Well, actually, the required minimum distribution, this is where it's really confusing. RMDs are set at 72, but to give to a qualified charitable deduction, you have to be 70 and a half. I mean, it's the government.
The ages have no longer lined up. They used to line up. They don't any longer. So if you're having to take money out of your retirement accounts every year, required minimum distribution, if you're age 72 or older under current rules, that amount adds to your income and you get taxed on it. And so one option that people have is they can do a qualified charitable distribution. So instead of the money coming out of your retirement to you, that money can come out of your retirement and go directly to a charity, in which, some people say, well, I need the money. And that's one thing. You might need the money.
Right.
If you are able to give charitably and you intend to, there's a couple of really interesting benefits here. The first one is the tax-wise. What would have been income to you and increase your taxes, it skips past you and it goes to someone else. But here, this is unique because it's a double whammy. If you were itemizing your deductions and you receive the income and then to give it charitably, you kind of take the itemized deduction. However, if you are not itemizing your deductions, you're taking the standard deduction on your taxes, but you do a qualified charitable distribution, it acts as if you get both. You get the standard deduction fully, plus you get to reduce your taxable income by redirecting it.
So you have to kind of back into this number, but for some clients, what it does is it reduces what they pay in Medicare premiums, and that's a big benefit. So Medicare premiums, for those of you that are over 65 and receiving Medicare, you get charged for that Medicare cost. And I think your base cost is around $170. But if your income is above certain levels, it can go all the way up to $450 a month. So, and it's prorated. So you got to go through these gates, I call them. But for people who are just starting their required minimum distributions, they could be caught unaware and all of a sudden be thrown up into a higher cost for Medicare. And so a QCD, if you're charitable by nature anyway, putting all or some of your required minimum distributions to a charity could help to reduce your overall taxable income and bring your Medicare premiums down to that lower level.
Yeah, that's right. And basically by redirecting this income, it doesn't fall into your taxes. So your taxable income just shrinks. And that for a lot of people can bump them into a lower Medicare bracket, as well as your Social Security, of whether or not that's taxable.
Yeah, remember your Social Security is taxed at 85% of the income that you receive. But if your income is below a certain level, there's no tax on Social Security.
So people who are receiving Social Security plus notable income might have some tax issues. And so for a QCD, to be able to take a qualified charitable distribution and bring down your other income, for some folks, it puts them around the threshold of having a benefit for Medicare, benefit for Social Security, and a benefit for being able to itemize their own deduction, take the standard deduction plus get a charitable offset. So it can be a great position for somebody.
Yeah, and I think you're listening to us right now, and you're probably trying to keep track of all the benefits.
That's right.
But there's a lot of complexity here, and you got to do this to get that. And so this is where the planning comes in, where we actually work through that and we determine. And we can, from a planning, now when it get really complex, we're going to bring the CPA involved into the process.
But it's very tax driven. Right. And this is kind of going back to the beginning of the show. This is the difference between reactionary giving.
Right.
Hey, I got a request. I want to just give them some cash, to really planning out and saying, I want to be generous this year. I want to give a notable amount. This is the amount I want to give. What's the best way to do that for your situation? And kind of to go through to say, okay, what is going to not just get the money to the charity, but what is going to, either use up some of your capital gains, what's going to reduce your income, what's going to reduce your taxes, and making sure that you're maximizing. And for some folks, it changes the analysis. Say, well, I was going to give, $5,000 out of my bank account, but now that we've done all this math, I can give $8,000 because I'm going to have all these other savings. I mean, you could be more charitable, or it can just be less significant as you give. And it's great that there's a lot of opportunity here, but like you said, it's not easy. There's ages. there's amounts, there's even, we haven't talked about, but there's thresholds of how much you can write off depending what you give.
Yeah, why don't you kind of flesh that out a little bit? Because a lot of people say, well, if I put $1, I get $1 write-off.
Right.
Well, that's not really
It's
true.
not always true, depending. And,
Right.
and it only, so the general framework is it all is based on the income you have that year. And so if you give cash, that's the biggest write-off you can get. So I think it's at 60%.
Right.
And
Of what, adjusted gross income?
Yeah, of your adjusted gross income. So if you made $100,000 in a year, that was your adjusted gross income, you generally can give $60,000 and get the write-offs for that.
Yeah.
Most people aren't giving, 60% of their income in cash,
Right,
but
right.
some do, especially in years where you have high income or something like that, and you want to give a big amount. Well, if you have very limited income and you say, well, I want to give all this appreciated stock that I've been sitting on for years. Well, you may look at that and say, stock, I think it's 40 or 30% of your
30%,
income, 30% of what you can give. So if you made that same $100,000, now you're limited at giving $30,000 of appreciated stock and getting that full write-off in that year. The benefit being, if you were to give more, you can just roll it over to the next year. You can take those charitable.
Yeah, the deductions don't go away. They continue to stay on the books, and you just carry them over. That's why some people, maybe if you're listening to us, you'll have a $3,000 write-off. It carries over from an investment that you had a loss, but you don't have any gains to offset it. So you get a $3,000 loss that you carry forward.
Yeah.
And I've had clients where it comes in and this $3,000 shows up on previous tax returns.
Yeah. It's year over year over year.
Year over year, year.
Right.
Yeah.
Because that's the only amount that you can offset from your regular income. So same thing applies here. The same types of limits, they're a little bit different for donor advised funds, but they're very similar.
Mm-hmm.
We always have to check the math and check the numbers of what people want to give. The other thing, just to put a comment on here as we're kind of getting through all these items, a donor advised fund, which we spoke a lot in the first section here. One of the nice things is privacy.
Right.
There's some people who like to give and everyone knows you gave.
Right.
There's other groups who, if you tell them who you are, you might get asked again next year. You might feel you just want to be anonymous and just bless somebody. Mm-hmm. There's an ability to set up donor advised fund that aren't just your name. Right. It can be the Brown Table Fund. And the Brown Table Fund is the one that then gives. And there's ways to kind of keep these more anonymous. Yeah. And people are using what used to be foundations, but also now donor advised fund to be able to fund charities that they care about without having their name emblazoned in lights that they gave to the charity.
Right. Yeah, a lot of people want to give anonymously anyway. They don't want to have, so to speak, an earthly reward for the gift that they give.
The altruism that they're working for.
Yeah, right. So that's something that now other people, they want to be noted.
Yeah, so they want their name on a wall. And a lot of places offer that as a benefit to say, you helped build this youth center, or you helped be a part of this, and put the names on the wall. There's nothing, I think, innately wrong with that. I think there's just some folks would rather not have their name there. And a donor advised fund is a method that people will sometimes set up to kind of insulate themselves a little bit. So they give to the donor advised fund, they name the donor advised fund something innocuous. And then the donor advised fund is the one that then gives to whatever charities they feel are appropriate. Yeah. So it's a nice piece. So we've talked about donor advised funds. We've talked about qualified charitable distributions. One, I guess, last piece is, how do you do this? Right. We manage a number of these. We set these up for our clients. We manage the investments in them. Fidelity has a great, for us, just as a comment, ours is, the company we use is about $25,000 is the minimum to kind of set these up. Fidelity has one without minimums. You can go on Fidelity as just a retail website and go through their system and find you want to set up a donor advised fund, and they have a zero minimum that you can start putting money in there,
which makes it really convenient for small investors.
Right? Yeah, and if you have this set up, and that's talking about end of year tax planning. Right. If you have one of these set up, you say, "Yep, $300 more, put it in," and you zip it over, and then you decide to give it in the next calendar year at some point.
Right. So again, I think giving, we always encourage people to give. I mean, at the end of the day, we think that what you have, and if you have more than what you need, it's a blessing. So therefore, we encourage people to give. And the question is, what we're talking about in this segment here today, in this particular program today, is how do you give? Yeah. And there's different ways in which you can accomplish the overall goals. And there's being smart about giving. If you just write a check for it, or if you sell something and give the assets, that may not be the smartest thing for you to do and give you the best benefits. And there's other aspects of benefit. Like, for example, we talked about reducing Medicare premiums and things like that. We want to kind of balance that out.
If you missed any part of this episode, you can catch it on YouTube. Go to Retirement Unlimited and find us there, or you can go to our website, which is retirementunlimited.com, and you can find all of our past episodes there. If you have a topic you'd like us to discuss on a future episode, you can use the contact button on our website.